down about 0.25%, 48,500. And you've got a Sensex down about 0.25% as well. So uniformly 0.3 odd percent cuts to begin the day. Advanced decline, broader markets have been steady. Actually, I would say they've been steadier as compared to the Nifty or the large caps. So 923 up and about 400 lower, but stocks are still opening up. Mid-cap index is down about 0.25%. Actually, even yesterday, the mid-cap index was down. Small-cap index ended higher. Small caps outperformed mid-caps. Small caps are flat. Actually, they're in the green again, while the mid-cap index is clearly down. So there's a divergence even there. So the smaller stuff is doing better as compared to mid-tier names. And I saw the micro-cap index, even smaller, that also was up sharply yesterday in terms of rebounds. The Nifty heat map is coming up on your screen, more down than up, certainly 30 down, 20 up, approximately 65 down for the Nifty to begin the day. Surbhi.
Okay, let's take a look at some of the movers and shakers on the Nifty. 57 points down, so I'm looking at the ones that are taking it lower first. Infosys, Tech Mahindra, HCL Tech, TCS, it's that, Nasdaq effect perhaps that's playing out. Just weak US tech, general weak sentiment around tech in India as well. And then there are some big boys like HDFC Bank, ICICI Bank. So even the banks are not feeling that great this morning. So IT and banks on the back foot. That's pretty much it. I mean, beyond that, a little bit of selling on ITC or Mahindra and Mahindra. But then let's talk about the green side. What's bouncing higher smartly is HDFC Life, 1.5% up. BEL is positive. There's some buying on names like Bajaj Auto. Reliance itself is a big support this morning, 0.5%. It's an excellent counterweight to the selling that we're seeing in IT and banks. There's Coal India, L&T. So it's very, very evenly poised. I mean, it's absolutely net neutral, which is why the Nifty is now just about 5 points lower. So big fight back. And while IT and banks are a little subdued, the others are coming to the rescue. Let's see. Maybe the Nifty. Yeah, Nifty's suddenly flashed green. It is green now. So the bulls are making their presence felt.
Well, that's right. In terms of stocks that are moving lower on, large volumes, I think PI Industries, that stock is down close to around 5.5% or thereabouts. Kumai will be declaring its numbers today, and we'll be waiting by for some commentary on that front. I'm not sure whether the numbers have already out, but Kumai is the one that's going to be coming out with numbers, and Pyrosar Sulfone is the one that we normally track in terms of commentary. So we'll keep an eye out on that particular stock. Besides that, stocks that are moving around in today's trading session, you have a couple of big winners. Kalpataru, if I saw that correctly, that stock in fact was well in the green because of their order win. So good going out there. A couple of other notable movers in terms of winners today. You have Khadim, not very high volumes out there, so we can avoid that one. But as we were doing that market check, actually, the markets have moved well in the green, from a 60-point downtick. So the first dip has got bought into, which is good news. Since the dollar index is softer, we have metals that continue to do well. Hindustan Copper, I remember the stock went to around 400 rupees, then it halved to around 200 rupees. That's the pure play, on LME copper prices. So that one, in fact, has moved up. Quess Corp, they've got that nod, I think, for the demerger, splitting of businesses. So that one as well is holding in the green. And Z Enterprises, as we had mentioned yesterday as well, the promoter entity coming in there, buying some shares after a long while. The stock is up close to around 2%. And keep your eye on Geo Financial as well. Volumes fairly good in the first few minutes of trade. Stock up close to 100%, but volumes very, very high. From the lows of this week, the stock is up more than 10%.
Are they coming? Are they coming in the distance? Can you see them? Can you see them? The FBI.
Okay, well, flattish now, so that's a pretty good outcome given the overnight screen. And that's the thing, right? Markets here paid the price, at least to some degree. And the US, of course, is maybe just about starting its correction. I think the S&P from the highs is now down about 6% or so. Nasdaq is down something similar. Here, of course, we've had 16, 17% falls already from the highs. So there's a bit of a lead lag. But these are the two markets which have been tightly correlated over the last 3 years or so now. I think best performing large markets for basically 3 years in a row. What else is going on? Maybe we can look at some of the other big movers which are coming up. Maybe just look at the IT index, IT and the Nifty Bank. These are the two underperforming sectors, and see if IT is still down. IT is down 1%, so that's being bogged down, and that's a large weighted sector, and the Nifty Bank is down as well. So just see through the course of the last 3 days when the markets have bounced, these are the two sectors which have bounced perhaps the least, between 1.5 to about 2.5%. Everywhere else, there has been sort of more enthusiastic recoveries as we've seen. Nigel?
Yeah, just wanted to point out Reliance Industries. We pull up Reliance Industries with the 20-day MA. The stock is actually very, very near to that. It's at the 20-day MA. So Reliance Industries, that's the one that's bounced back a little bit from the recent lows. It's been a relative underperform over the last few months or so. But now brokerages are getting constructive, both on the valuation parameter and the triggers going ahead as well. And as we speak, spot on, Reliance Industries is now at the 20-day MA. The other one I'm looking at is Gensol. The negative news flow continues. The CFO as well had resigned. But take a look at the stock. From the lows of the day, actually, the stock is up closer on 10%. So the last few trading sessions, it's been at lower circuit. Now volumes on the NSE I checked were closer on 15 lakh shares. Pull up Gensol. From the lows of the day, the stock has seen a sharp recovery. Last few trading sessions, the door was shut. You couldn't get out of it. Volumes are very, very low. But as we speak, I think that's the BSE volumes. On the NSE, the volumes are far higher. So keep an eye out on that one. I think the intraday chart will give you a better picture. And RITES will be getting the management with us, in a short while from now. That's one in order. That's up closer on 4.5%. So good move on that one as well. And Kalpataru projects, now that one is screaming away, up closer around 6% or thereabouts. So it's a good start. Hopefully by the time we wind up, it'll be as good, particularly the breadth of the market. 3 stocks advancing for just 1 stock that's declining.
Okay, so yeah, some more names on the gaining side. The only issue is volumes. How many of the stocks really have reasonable volume? Some of the consumer names like a Barbecue Nation moving higher. There's Aptech. Haven't seen this stock in a long time. Market cap is up 1,000 rupees now. That's up. Kalpataru projects, obviously, because of the order wins they've announced. Smart order wins, over 2,000 crores of additional orders.
On Aptech, there was a large trade yesterday. I'll just try to get further details, but there was a large trade yesterday, so I'll just check out what exactly happened.
That makes sense, because we haven't seen it come up on the price and volume charts in a while. 7%. Today, Interglobe Aviation is not quite flying. They're going to Amsterdam and to Manchester, long haul. Stock's not flying this morning. It's far more mutish and flat. And Hexaware, of course, the management will speak with shortly. First numbers coming out after their listing, should I call it relisting, basically re-entry on the street. The growth is fairly anemic, 1.2% constant currency terms, and we'll get an outlook with them going in a bit. But let's put the spotlight on Reliance now. We have Sudarshan joining, and I think he's looking at some reports and some data. So what's happening?
So in the last 2 days, we saw 3 positive notes on Reliance Industries. Yesterday, we saw that Kotak had upgraded the stock to buy, and even Jefferies had maintained buy. And both Kotak and Jefferies had increased their target price. Kotak had a target price of 1,400. Jefferies had a target price of 1,600. Now today, Macquarie has come out with a note. It has too updated the stock to outperform, and now its target price is 1,500 per share. So somewhere implying an upside of around 20% from current levels. So what does it say? It says that it has underperformed MSCI India by 18 percentage point and underperformed Bharti Airtel by 60 percentage point in last 1 year. Now, why it has upgraded the stock? So basically, it's expecting few incremental positives over next 6 to 12 months. Also, it says that FY25-27 EPS CAGR is now seen in the range of 15 to 16% versus mere 2% over FY23 to 25. What will be the key catalyst as per Macquarie? First, better earnings momentum. Second, potential geo listing. And last is gradual commissioning of new energy capacity. So on the back of these positive notes, yesterday we saw an uptick of almost 3% Reliance Industries, and even today it's higher in trade.
Okay, all right, got it. Thanks very much. Explains that move on Reliance and Sudarshan. Let's now talk about Hexaware, the stock that I was just discussing, which is down about 1.5%. Those numbers came through. Let's do a deeper dive with Rima. So Rima, just 0.2% top line growth, right?
Indeed. So just 0.2% in Q4. But remember, Q4 is a seasonally weak quarter on account of furloughs. And the management just held their conference call. And in that, they were indicating that some uncertainty has emerged in macros in the last 2 to 3 weeks. Prior to that, things were looking a lot better. And the sectors they're going to watch for would be manufacturing, consumer, because here there would be a first order impact of Trump's tariffs. So some uncertainty has, crept up. So which is why this time, unlike, a couple of years back when the company was listed, they used to perhaps give you a numerical guidance. They would say that this year we're going to grow at 10 to 12%. This time, all they're saying when it comes to the outlook is that the performance will be resilient to modest macro changes. But of course, if the macro gets worse, then it's everything gets thrown in. In terms of Q4 numbers, constant currency revenue growth was just about 0.2%. The company managed to expand margins in Q4, and that's because Q3 was a wage hike quarter. So Q3 margins were depressed. So on that lower base, margins have expanded by 30 basis points. For the full year, calendar year 2024, the company's clocked in a top line growth of 13.5%. But there are a few positive, sound bites coming from the management. One, they're saying 2 out of their top 3 customers are going through consolidation, and the company has won those deals, which will ramp up Q2 onwards. And secondly, 2 significant deals, consolidation deals, are in the works. If the company wins, then growth will pick up in the second half of the year. So the outlook is a little more uncertain, but the company's performance is likely to be resilient in the face of that. Back to you.
Okay, all right, got it. Rima, thanks very much for the inputs over there. By the way, the market's turned, so there is some volatility. It's not an uptrending start immediately from the word go. That flat line has now again become a 40-point downtake, and there's about a 0.25% decline on the mid-cap index as well. The bank nifty is the one that's the problem point. Remember, we told you that it was IT stocks and it was banking stocks that were leading the decline. The bank nifty is now down about 0.4%. Some of the key names include ICICI Bank on the way down, IndusInd Bank, Kotak, HDFC anyway was weak. So this is where the problem is. I just want to make one more point on the overall Asian picture this morning. Asian markets are showing a lot of divergence. So remember, we had this huge weak slam dunk from Wall Street. Asia is taking it in a very different way. The Chinese markets have moved higher. I was about to say that our market has also marched up, the Asian giants, China and India. But now we're kind of wobbly. Japan is underperforming big time. The Japanese market is down about 2%, and that's because their currency is surging higher. Obviously makes exports that much less competitive. So that rising currency is a problem for Japan. They're anyway going to go through a rate hike cycle as well. So Japan is slightly different. But China's doing very, very well, and we have been doing really well, and hopefully, green will be our color in the next couple of hours.
No, I think, Surabhi, there's only one market to watch in Asia, that's China.
Yeah.
I mean, except us. Because that's essentially what is, things are happening, things are moving, and after many years, there's this AI, the tech prowess is essentially being displayed very, very strongly. And it's a clear divergence, right? 0.5% higher. Hang Seng was up, and this is after 3% yesterday. And of course, I mean, a pretty decent run that that market has had this year. And
also, money doesn't wait for certainty, right? It can't. That's the nature of markets. Yeah. So while the US figures out if those tariffs are staying or if they're getting rolled back, and what is the impact on GDP, is it 0.5% or is it 1%? Money's not going to wait. Money's getting maybe 5% growth, about 5% in China, hopefully 6% plus in India. And we're only hoping that money is moving. It's definitely moving to China. That's what I'm saying. I'm looking. Maybe they're coming. The FPIs.
No, I think the other thing to consider is that, the weekend, there's always news flow risk, etc. But now with Trump, I mean, that risk is, remember what happened last weekend, right? There was that, it was, of course, not big for India in that sense, but there was the Zelensky fiasco. It turned into a shouting match in the White House. So who knows what the weekend brings. Usually we go to sleep, come back the next day, so there's one-day risk. But here you got 2 days, Saturday and Sunday. And I think with this amount of staggering news flow, it really becomes real. For if you're trading, I mean, you don't want to carry positions, into the weekend, especially not at a time like this. And I think that's at play as well. 36 points lower, 22,500 is where we are at. Lots of stocks are moving around. We'll address more of these as we go along. But I think we have our first corporate interaction, ready with us in just a bit. I think I just want to mention just one thing. Gensol is coming up, is the second largest volume-led mover right now, and it's up 1%. I saw it being up 4%. It was limit down, lockdown. It's up 1%. Rating agencies essentially saying documents were falsified. We had the management with us, CFOs resigned, 340 or so. So that's the story which we will continue to follow. Otherwise, a little lower this morning. Nigel, the RITES management is with us. Okay, I think...
we have Mr. Rahul Mithal, the Chairman and Managing Director of RITES. He's actually with us in the studios. Mr. Mithal, great to have you in person with us. Thank you so much for joining in. So we want to look beyond the third quarter, and the third quarter was obviously not the best for RITES because most things were down. I'm just looking at the numbers right now. We'll put them on the screen. about 15-16% decline in top line. Margins fell quite a bit. And it seems your high margin business, that's where maybe there was a delay in execution. I'm not quite sure. But you tell us if execution is looking better in Q4 and what can we expect?
Yeah, morning. I think, yes, you're correct. The Q3 and the previous quarters also, this 9 months, the aim was to try and execute the existing orders and have an aggressive growth in the order book. And the key hit was because we didn't have any export orders for last about 3-4 years. The orders started flowing in the last 3-4 quarters. And these will start generating revenue by early next FY, so Q1 of next FY. Another hit was the quality assurance business of the Indian Railways, which opened up on a competitive basis. So if you see the 9 months, there's a total hit of YOY of a top line of about 200 crores and the bottom line by about 80 crores. So that's the huge hit. But moving forward, the aggressive order inflow that we've got and improved execution would see a sequential improvement. And that's what's been happening if you see Q1, Q2, Q3.
Your order book is around 8,000 crores, yes, right? That covers you over how many quarters? And what is the addition that by the end of this year, where should the order book be?
So you see, this quarter has been an all-time high. We got 110 plus orders totaling to 1,900 crores, which is a huge jump. In fact, this quarter, the 1,900 crores is nearly equivalent to the entire previous FY of about 2,200 crores. So 8,000 crores order book roughly covers about 2.5 years. And with this level of order inflow, we are aiming to cross 10,000 crores in at least the next 2 quarters. And we are maintaining that strike rate, that milestone, which we achieved about 4 quarters back, of being a 1 order a day company, 1 order a calendar day. So we maintained that strike rate even in this Q3. And we are sure that we'll be able to maintain this in the coming quarters.
Well, kudos to you and the team, sir, with regard to the order wins. So well done on that front. What the stock market wants to understand, your investors are waiting for is execution.
Yes.
This year, as you warned earlier, that it's going to be a bit of a subdued number in terms of revenue, and there'll be a bit of a degrowth for this year. So what are you planning on ending this year with in terms of revenue? Point number 1. Point number 2 is, on that depressed base, I think you were guiding for 20% growth on revenues. Is that on for FY26? And margins will hold in this 20-21%?
Yes. So in terms of 9 month to 9 month, we were down by about 11%
Yes.
on the top line and about 25% on the bottom line. As I said, the execution has been improving sequentially.
Right.
And what we are aiming is that we end the year at least to try and bring down the top line dip to about 10% or below and bottom line dip to about 20% and below. And this guidance of next FY growing substantially, at least 20% on the top line and at least 10% on the bottom line, that remains, because with this order inflows coming with the way they are coming, even in the Q4, which has happened about 1.5-2 months, we are sure that these orders will start generating revenue next year.
Give us your take on the competitive intensity, because exports, that's the one I think where you get a higher amount of margins. But I believe competitive intensity there as well has gone up, and that's why the margins have come down. So could you comment on that, on the exports? And also the Indian Railways, I think the contribution has come down a little bit. Where do you see this number stabilizing at? And comment on the competitive intensity out here as well.
So that's a huge change in our business scenario, quarter and quarter, every passing year. In fact, this quarter that we ended, 60% of our order book is on the competitive basis. And even in the export line of business for the last 5 decades, all the orders that we had got were on the line of credit export business. This was the first time in these last 3 quarters that all our export orders are on a global competitive basis. So even the Bangladesh order for 900 crore, that's a global tender. So obviously the margins have dipped and will dip even in the export stream of revenue. So moving forward with the increase in all my streams of business in the percentage of competitive orders, the margins are settling down in this range of about 20-odd% EBITDA margins and PAT margins about 15-16%.
Mr. Mittal, government share of government orders are, what would it be, I mean, as you go forward, as you look ahead? Because that's been coming off, right? From 60%, that's now about 40-odd% or so. I mean, government business. So it's more and more dependent on the private sector in that sense?
So you see, our USP is that we have all areas of infrastructure consultancy except oil and natural gas under one roof. We have 13 different verticals. And as more and more big private players come on to, infrastructure areas, whether it is ports, airports, buildings, highways, etc., we are being able to tap them. And that's the reason, if you see the overall mix, while the orders are coming in from all quarters, but in terms of the ratio moving, if you compare year on year also, the ratio of private orders is also increasing. And I see that happening even sequentially and even in the next FY.
But will that sort of, and the government side, the orders are on a nomination basis, it's competitive bidding? I mean, how does it work?
No, in fact, even on the government side, whether it is the central government ministries, state government, or PSUs, other PSUs, many of them have a competitive bidding, or sometimes based on our experience and credibility and our credentials, we also give they give us orders on a single tender nomination basis. So there is a mix of both. But last year, the ratio of competitive to nomination was about 50-50, or in fact, the nomination was above 50. And this quarter, as I said, when we have ended with an order book of 60% competitive. So that's continuously changing, not only the ratio between competitive and nomination, but also the ratio between government and private clients.
So, Mr. Mittal, what I'm trying to understand is you said that margins on a going forward steady state basis should be at about 20%. 20% is a new normal, which is lower from where you've been. Is that because in the portion which is competitive bidding, the competition is really high? Or is it because there's some issue with your higher margin business? And what is your premium margin business? What is your low margin business? If you could just explain, why is 20% this new normal?
So, you see, the main reason is because 2-3 key streams of business, as you correctly said, which were traditionally high margin areas. For example, export of rolling stock, which was always a high margin business, about 20-25% range margins. And these were, as I said, line of credit orders. So you had primarily lesser competition. Only Indian companies could bid for that. Now you're participating in global tenders. This 200 coach order is a global tender. So obviously the margins in that stream have gone down.
So it's getting very competitive.
Very competitive. Got it. The second, another very high margin stream of revenue was a quality assurance vertical, which was doing business on a nomination basis for Indian Railways, which accounted for about 60-65% of this revenue for last 5 decades. Now that opened up about 1.5 years back through 4 players on a competitive basis. So the pie got divided between 4 players. And the rates also came down. So that itself, in 9 months, that has had a hit of about 50 crores on the top line and also on the bottom line. So areas of high margin streams of revenue have not only opened up, so that's taken an overall hit in the overall margins.
So places where you had monopolies, strong monopolies earlier, now there are other entrants that have come in. So margins have come down to 20%, and that looks like the new run rate. It's a new reality that investors have to deal with. So one can only hope that your top line makes up for it. More orders, more wins, better execution, and better, CAGR top line growth. I think you've given us some estimate of what the new year will look like, but, what can we expect? Can the top line growth look better than where it historically has been on a going forward basis?
Exactly. So because of this reason, our clear strategy was not only to improve execution in the existing orders, but have a very aggressive order inflow. And that's why we targeted 1 order a day. 5,500 crores was the closing order book on 31st March. We are now at 8,000 crores. We are targeting 10,000 crores in the 2 quarters. So moving forward, our highest ever revenue has been about 2,750 crores. Moving forward, we are aiming to definitely cross that. We are aiming for 20% growth next FY, even on this lower base. So as you correctly said, higher order book, faster execution will take us past the previous highs.
Mr. Mittal, have the internal changes have all happened over the last 1.5-2 years? Because now you're in the marketplace for orders. You've got to, the nomination side is, the pie is lesser and lesser. So, and you're dependent on the private sector. I mean, this capex cycle, whether it'll come back, not come back, whatever. But internally, are you all set, prepared for, to go out there and get orders in that sense?
So in fact, 2 things. One, in terms of taking a conscious call, because when you're going for aggressive order inflows, and in consultancy, the minute you get an order, you have to deploy people on the project sites. So even though this was a tough year and we knew that we were going to be lower than last year, we took a conscious call. We've inducted about 300 people in the last 1 year because we know that these orders will start getting and they will require people, deployment on the site. So that's in terms of fresh taking in resources, and we are already continuing with that. Another about few months, definitely we're going to take at least 100 people more. And internally, more and more getting, adapting and becoming more agile to competitive bidding, both domestic and international. We recently got an 80 crore highway order in Guyana through a global competitive bidding process. So that's just making us more and more agile. So it's a two-pronged strategy: internally agility and taking in more resources to, be able to tackle these aggressive orders coming in.
We wish you all the best of luck, Mr. Mittal, to you and your team. And thank you very much for dropping by to our studios. Appreciate it.
Thank you.
Well, thanks very much. We'll take a quick commercial break here. We're going to come back in just a bit from now with a quick check on markets, of course, which are down there. 30, 40 points, 50 points lower now. But the next management also with us, that's Hexaware, recent listing, because it's in a way, it's a relisting. Hexaware Tech to discuss their numbers and, of course, the outlook going forward. We'll have the CEO and the CFO join us for that chat. Stay tuned.
Well, Hexaware Technologies reported their past quarter's numbers. The company expects this calendar year to be resilient. To discuss that and more, we're joined by Mr. Sri Krishna, as well as the CEO and Executive Director, as well as Mr. Vikas, the CFO of the company. Hi, gentlemen. Good morning, and thanks a lot for joining in. Well, you'll have given some commentary with regard to this year, and you're expecting things to progressively improve Q2 and then Q3. But you'll have not quantified it. How much better can calendar year 2025 be in comparison to 2024? If you could give us a rough range as well, will be good.
We're coming back to markets after a while, and we've decided consciously not to provide a guidance. But I think there's some color and commentary that is valid. We are very confident about what 25 looks like. We've specifically said investors should not get worried about the news cycles and the macro changes that is led by the administration in the US. Our business and our order flow is resilient to that. We have 2 significant consolidation deals in 2 of our top 3 clients, which the ramp up is expected, like you said, in some in Q2, majority in Q3. And there are 2 more such deals in the offing, which, we may or may not win, but even if we win one, it'll actually portend a very good future for us. Our expectation is to do better than the past. If you look at 24, in a difficult year, we did 13.7% growth. Most companies in our industry, vast majority, were in low single digits. Materially outperformed the industry, and I expect that we will continue that outperformance.
Okay. All right. So at least 13%. Gentlemen, good morning. Prashant here. Mr. Jain, at least 13% is what Sri Krishna is telling us?
As Keech called out, we are not giving any guidance, but we are giving.
Okay, so that was my question, Vikas.
Which indicate,
Yeah, that was my question. Why not? Because simply because is it tougher to give a guidance because it's, and I completely understand things are in a bit of a flux and changing all the time now, at a much faster pace than when you were actually first listed in the markets, right? The first time around. Is that the reason, or is there any other reason?
So, no, actually a reason for not providing guidance is not here and now.
Okay.
Our temptation for the current year is to provide a guidance. There's a lot of confidence. But not providing a guidance is keeping in mind the next 10 years. We'll go through a lot of different cycles. So we think it's best that we don't provide a guidance long term.
So things are, you expect things to change significantly. And you'll have to sort of pivot to those changes. Is that the way to look at it?
That is correct. And we've done that successfully always, and we will continue to do so successfully. We just think it is good practice to kind of provide enough indicators, confidence about our business that we are.
Sure.
But stay away from actual guidance.
Okay, so you're steering away from actually putting a number to those expectations. Got it, gentlemen. I just want to talk about the update that you've given with respect to future deals. You said that 2 out of your top 3 customers are going through consolidation. Those are deals you've won. You've also said that there are 2 more significant consolidation deals in progress. Can you give us some sense on how large these deals are? What's their nature? What are the sort of margins they come with? Vikash, maybe if you could take that and give us some more color on by when does this start showing up in the P&L? In Q4 itself, the next quarter itself, or will it take longer?
So just wanted to clarify one thing, that the year that we follow is calendar year. So it's Jan to December. So the results that we came out with was Q4.
So it will be Q1. So exactly, whether these deals will come up then in Q1 or, otherwise it will be Q2, calendar year
no,
Q2
it will
for you.
start. It will start. So it will start reflecting from April to June quarter onwards, so which is Q2 for us. So you'll see that the deals will start ramping up from a Q2 perspective, but the full impact of that will get reflected from Q3 onwards, which is in the second half.
And what's the size of these deals? These consolidation orders as you describe them?
So these are large customers, from both perspectives. One, they're large for us. These are very large companies with very large spends. And they are reducing the number of people that they're distributing that spend with. So the incremental spend on take is material, but they're not in the form where they've said, hey, this much goes to person A and this much goes to person B. It will evolve over a 2-3 quarter period, but it'll be significant.
Okay, all right. I wanted to focus on a couple of other aspects. Europe, I think, is close to around 18% of your total mix. And actually, that's been growing at a slower pace in comparison to the overall business. However, the sound bites that are coming out of Europe in the recent past have been quite positive. Do you expect Europe to do relatively better from this year on? Are those the signs that you're getting? And also, margins have been in the vicinity of close to around 16%. On the profitability aspect, do you think there is scope to improve from year on, or will it stabilize at these levels? Europe as well as margins. Please go ahead.
On Europe, if you zoom back a little bit, our performance for Europe has been very good. In the last year, it slowed down, and you're right, the expectation is along the lines you said, that it will improve. It will improve back to at least company average in 25.
On the margins, you're right. We are going to be improving our margins very meaningfully from here. From a full year perspective, we reported a margin which was in the range of 15.9%. Operating margin EBITDA, we expect that to improve to 17% plus in 25, and it will further improve to 18.5 to 19% over the medium term of 3 to 4 years.
All right, I had more questions, but we're out of time, gentlemen. Thank you very much, and hope you come back again, and we can continue this conversation. Thank you very much, and good luck as you sort of look ahead into the rest of the year. Rahul Jain is co-head of Asia Financials and head of India Equity Research at Goldman Sachs. He's with us now to take some questions. Rahul, great to have you with us here. Thank you for your time. So the market seems to be bouncing a little bit. But the one sector, prominent sector, which is underperforming in this, I mean, I'm talking about very, very recent markets, about, from the lows last 3 days, is financials. And this despite the fact that the RBI has come in again with maybe, according to some, a larger than expected boost to liquidity, replacing durable liquidity in that sense in the market. So what's the top bother in that sense, Rahul? Is, I mean, a sector which is widely acknowledged as cheap and has not performed for a number of years, reasonably valued in that sense. Go on.
Thanks, Prashant, and good to be back on your show. Before I take a deep dive into your question, let me just paint the overall picture the way we see it. Last year, we called out that the Goldilocks period was over for the financial sector in India. And this year, we called out that there could be a muddle-through scenario for the sector because the earnings still continue to face the headwinds emanating from all the three factors that we are possibly seeing out there, which is asset quality. You all would be seeing what's happening in microfinance space due to Karnataka ordinance. The asset quality in unsecured is going through its journey. We've seen the credit growth drop significantly from the highs of mid-teens to high teens. And of course, the rate cuts, which will also have its bearing on the margins initially, and then gradually we see how the deposit rates shape up. So clearly the earnings headwind still remains for the sector, and we are yet to see the bottoming of that to happen. We feel that the bottoming out of the earnings cut would most likely happen by June or September quarter. But what we are positive about is the regulators have started to support the sector. You talked about easing of liquidity. We have seen in the last couple of weeks, the regulators come out and ease certain measures such as rollback of risk weights on NBFCs or microfinance lending, etc., which is quite positive for the sector and will ease the regulatory risk premium. But clearly what the market is looking for at this point of time is the earnings cuts, when do they bottom out, what happens to the margins in the near term. But if you see last few months or so, banking sector on a relative basis has held up well, whilst the other sectors were seeing the beating. So we feel that as the confidence returns back on the fundamentals, I think the sector should start bottoming out, but the headwind still remains.
Okay, so maybe you're saying tactically people are looking at financials more favorably, but you're still concerned about some of these issues. I just want to focus on, Rahul, this asset quality piece that you touched upon. If you could expand on that. Where is it that you're still seeing stress? I mean, there was a lot of debate around this, that maybe the worst of the MFI stress will be over by, say, Q1. What are your projections telling you in terms of timelines? And also the RBI has actually withdrawn some of those macroprudential norms, right? The higher risk weights on loans that are going in for NBFCs or MFIs. So that's already been rolled back. So I don't know. I mean, clearly the RBI felt that it was the right time. There was no need to be as tight anymore. But you still sound a bit concerned. So just elaborate on this.
Sure. Thanks, Urvi. So look, on the asset quality front, we started about 2 years back with our concerns on the unsecured lending. We've seen the last 6 to 12 months that reflects in the numbers for the financial entities. And then we saw how the macro slowed down. We all are witnessing what's happening to the GDP growth slowed down in between. The collection on the GST front were tepid. We also noted that the truck rentals or the freight movement also took a bit of a knock. That started reflecting in the higher delinquencies in some of the commercial retail assets, such as commercial vehicles or MSME loans, etc. So when you look at the bottoms up, I think we still have some way to go before the credit costs peak. We feel that it will likely to peak by September quarter. So still 2 more quarters to go for. But mind you that typically the second half in the financial year always tends to be stronger. But this year it has been a tad weaker, and we'll be getting into the first half, which generally is weaker. And there is a IMD projection out there which talks about the heat wave, etc. So I think that concerns the investors that when do we get the confidence on the earnings growth, and particularly if asset quality still remains a concern, then the re-rating takes time. But you rightly alluded to the point that the regulators have been doing to support the sector. I think that's been a big improvement in the last month or month and a half since the new governor has assumed. So we are seeing that the regulatory risk premium, which had gone up in the sector in the last 2-3 years due to tightening measures, should start to ease off. And these are some of the initial measures that the RBI has taken to support the sector. It will take time to show up in the real numbers, in the real economy numbers, or in the credit growth numbers. So we'll wait to see how that plays out.
Okay. Hi, Rahul. Good morning and good to see you. And Rahul, a couple of questions. I recall you calling out there's more pain in MFI, but do you think it's likely to peak out in the coming quarters? And also, I think you had preference for the housing finance companies, because that's far more secure. Does that preference hold?
Thanks, Nigel. So look, I mean, microfinance, from where it is sitting, naturally, it should likely to improve in the subsequent quarters. But still, the profitability that used to be generated in this space will take time. Like I was earlier saying, second half is typically stronger, but this year it has been weaker, and we will be getting into a period which generally, has see a slower progress into the year. So we'll see. So it's going to take time. It's going to be more of a second half story into the next financial year than the immediate next few quarters. But yeah, I mean, on a relative basis, we've been very, very selective. We clearly like the stocks, where the asset quality is under control and the earnings predictability is very high. So whether it's housing or whether it's commercial retail assets, wherever the ROAs and the asset quality is under control and valuations are not demanding, clearly are the names which our investors are preferring at this point of time.
Interesting that you're saying that, Rahul, but I'm looking at the list of buy calls, and let's pull up the stocks as well for our viewers' reference. Chola Finance, there's SBI Card, there's Shriram Finance, then there is L&T Finance, AU SFB, Aavas, and the large banks include Kotak and HDFC Bank. So I just wanted to come exactly to that, Rahul, to understand the thought process behind the stock selection sort of criteria. And you said that asset quality needs to be stable. That's the number one thing that you're looking at. And then, of course, you're looking at overall valuations. So in the mix, I know you can't talk individual stocks, but I mean, SBI Card is the one I'm referring to. Let's not talk about the stock or levels. But in general, clearly, you're also pivoting towards some of the unsecured, lending setups, though you are cautious. So how does that tie in together? Is that a valuation thing?
Good question, Surbi. Thank you so much. So without getting into the specifics, I think financials is all about catching the cycles, right? So our view is very simple, that at some stage, unsecured will likely to peak. And, we're already seeing from the bureau data, the credit card delinquencies has started to moderate. And particularly the book that has been written in the last year and a half is showing a much better trends. So as the balances builds up there, you will see an improving performance, coming out of this particular segment of unsecured. And we are calling out that, by June to September quarter, you will see the asset quality peaking for the whole sector. Now, basis this and what profitability each of these segments will generate and where, does the, valuations lie is the call that one needs to take. So like I said, we prefer the names where you got some incremental comfort coming in on asset quality, profitability remaining, quite decent, and the valuations, have been derated over the last, few months or few quarters are the names that we are preferring. But at an overarching level for our investors, we, broadly categorize these into three buckets. First bucket belongs to the liquidity. As the liquidity gets better, some of these names will tend to benefit. The second is the interest rate sensitive. So the names where the impact of interest cut would be lower on the margins would also likely to benefit. And third is clearly, in terms of commercial retail assets versus the unsecured, where do you put your money? So I think unsecured is still going through the journey, will take at least a quarter or two more, and then you need to pick your bets. We clearly feel that credit card is early in the journey. You will see that first bottoming out because it is the first segment to go down when the cycles turn, and will be the first segment to come out when the cycles will start to improve.
All right, Rahul, we'll leave it there. Thank you very much for joining us, and it's a pleasure as always having you here on the program. Well, markets are seesawing a little bit. They were up, they were down, they're flat now, so 22,540. Mitesh is back with us. Mitesh, quick thoughts on what you're seeing and any trades at all?
So Prashant, I think, the idea remains that this is a market which on the hourly to hourly charts is, still doing that counter trend rally, and therefore declines should be bought into. And I believe that eventually in the next few days with some volatility, we will head towards 22,750, 800. With that kind of view, 22,350 is my support pivot. So get closer to that, about 22,400, 420, 430 zones. That's the buying area. And on the stock side also, we are trading with more of long bias. So I have a buy on EV Capital with a stop at 157.90. Look for target of around 168. And BHEL is the other one. That's a buy with a stop just below levels of 195 for targets of 212.
Okay, all right. Thanks for that, Mitesh. We'll take a very quick break on that note, come back in just a bit, and we'll be in conversation with Prashant Khemka, founder of White Oak Capital Management. Stay tuned. Welcome back. Let's get a market conversation going now. Some perspective at the end of what's been a week of relief for the Indian market. We have Prashant Khemka, founder of White Oak Capital Management, joining in. Prashant, always a pleasure listening into you. Thank you so much for being with us. And that's exactly what I was saying, right? Finally, a week of relief when India's outperformed as chaos and turmoil and confusion has gripped a lot of global markets. So that's really the question that, we don't want to get ahead of ourselves, but one can't help but start feeling a little excited that with the US market faltering, things a little confusing on tariffs over there, with these, will these elusive FPIs, will they finally start looking at India after the correction?
It is true that over the last few months, the massive selling that we've seen in India, in our assessment, is in great part to do with everyone around the world, big institutions, HNIs, or retail investors, they're all flooding money into the US and taking it out from elsewhere. Yeah, and it's not about negative about India as much as it is negative about or more positive about US compared to everything else. Now, in case this little bit of volatility in the US, whatever it may be attributed to, if that leads to reassessment of that of investors' sentiment or investors' viewpoint that US is the only place to be, then yes, all other asset classes would see some relief. Yeah, but it's very hard to say. It's, markets are, not, I correct myself as I correct everyone else. I correct myself. It's not just very hard to say, it's impossible to say how this would evolve going forward. But yes, as of now, market in US after some while has been more choppy than the unidirectional manner it was rising in.
All right. Hi, Mr. Kemka. Good morning, and always good to hear your thoughts. Plenty of moving parts, right? Difficult to call which side the market's going to go. But fair to say that post this correction that we've seen in the Indian markets, the headline index is down close to 15%. Individual stocks are down 20, 30, 40%. Do you think bulk of the bad news is in the price, or is the call for a sharper correction from here on? I want to understand how you're feeling about the Indian markets.
Sure, Nigel. So I generally tend to always believe it's a good time to invest and not try and time the market. And today, particularly after the drops that you mentioned in the headline, larger cap indices or broader indices, yes, I think the froth is out. So all the more reason to not worry about, though ironically, when markets go down like this 10, 15%, even those who think of themselves as long-term investors, they start worrying about it and try to play the impossible game of trying to pick the bottom or time the market. But I would say for any long-term investor, it is a very good time to stay invested, and if they aren't invested or have some money in cash, to deploy that. For short-term investors, I can only wish good luck as always, because that's what they need.
So, Prashant, the other issue is, like you're saying, it's impossible to predict which way the wind blows in the US with all this tariff business. But let's look at what's happening here at home. This whole sell-off was also triggered because of the concern around the Indian slowdown and, earnings trajectory, so on and so forth. So even if FPI money starts to come back, and when it does, we don't know. But the slowdown concerns here, do you think they are now fully priced in? And now we should look at a recovery in terms of both earnings and overall macro data?
Surbi, as you very well know, at any given point in time in the market or the economy and all these put together, the global politics and global economics, national politics, national economics, equity market and all the things associated, corporate earnings, and the various macro indicators. There are, as in Hindi you say, 17. So there are 17 things that are right, or 17 things that are right, and much more than 17, but let's say 17 things that are right and 17 things that are going wrong. Now, when markets are doing well, as they were till not long ago, people, everyone in media and investors and fund managers, they all tend to focus on and highlight those things that are going right. And when market, wobbles or pulls back a little, everyone prefers to and chooses to focus on the 17 things that may not be going right. So all this slowdown in the past, whatever many years you pick, 5, 10, 20 years, there have been numerous such slowdowns that have come along the way. Even if you take the last, 11 years or so of Modi regime, there have been a number of times that slowdowns have occurred. But then, that's part and parcel. You won't have a 6% GDP growth like a smooth line. Just like we haven't achieved that over the last 30 years, where our average has been 6%. We've not achieved it in a smooth line. And the same way, we haven't achieved whatever 12 odd % annualized return that the market has given over the last 30 plus years, since early 90s, since liberalization. We haven't achieved in a straight line, and we're not going to achieve that in a straight line. So these ups and downs are going to come. 3 to 4 months, 3 to 6 months ago, everyone was complaining, market's too high, I'll wait for a correction. Now, when there is a correction, everyone was worried, oh, this thing is going bad, that thing is going bad. Nothing is much different from what it was 6 months ago. It's just that people are now choosing to talk more about those things, those 17 things that aren't so rosy. And now that you have a correction, you want to wait for everything to be rosy. Everything's never going to be rosy.
Okay, all right, Mr. Khemka, good to hear your thoughts. A short point, I think you're sounding bullish on the markets. You believe, as always, for a longer-term investor, it's a good time to buy post this recent correction, and you're not too worried about the near-term, uncertain patch that we're likely to see. Thanks a lot for joining in, but we look forward to having a longer conversation with you in the coming weeks as well.
Likewise. Thank you.
Well, as we had that conversation with Mr. Khemka, take a look at the markets. We've seen a good recovery, courtesy Reliance Industries. That's the one that's fighting for the bulls in today's trading session. Time to slip into a short break. On the other side, we'll have a special segment, Indianomics. Lata is going to be joining, and she'll be celebrating International Women's Day by discussing finance and the economy with top 4 women bankers from Standard Chartered Bank. Stay tuned for that conversation.
Today, Indianomics celebrates International Women's Day, and joining me to parse the Indian and global economy, banking, currencies, bonds, loans are 4 top women bankers, all from the same bank, Standard Chartered Bank, Mumbai. Joining me are Zareen Darwala, the CEO, India and South Asia, Standard Chartered Bank, Ankur Khurana, the co-head client coverage, again, India, South Asia, Parul Mittal Sinha, she's head of markets, South Asia, and Anubhuti Sahai, chief India economics research. Ladies, it's a pleasure having all of you with us. Thank you so much for helping me celebrate International Women's Day. Zareen, that will be my first question to you. Does Stan Chart do something special that it is able to get so many bright women to the top?
So, Lata, we have 31% of our colleagues are women, and it's a very conscious effort to ensure. So, when we recruit also, we try and at least ensure that when we're recruiting, we have that same ratio, even higher. Also, something that Standard Chartered UK has signed up in 2016, it's a HM Treasury thing that we've signed up to, where there's a senior person from BEL's management team who's sort of in a way responsible, and we have undertaken certain pledges on what we will do in terms of diversity. Having said that, in India, something that has worked extremely well is we have daycare centers.
Yes.
And
in the bank?
In the
Near
bank,
the bank?
in Bandra Kurla prime location, we have 5,000 square feet daycare center, and we have at any point about 50 kids who come. So these are things that we really sort of support our women who are coming back from maternity leave. We also give 6 months maternity leave. We give paternity leave. We also give flexi working. So these are few measures that we've done. Apart from that, I think we have a lot of groups that we sort of have created. We call it Lean In, where if a woman has any things that she wants to discuss, like a mental health issue or any support issues, etc., there are themes that are discussed in the Lean In circles.
Okay.
And we also have something called Sheroes, where we teach women for self-defense, you know, suppose some unforeseen situation turns up, how to defend. And then we also have something where we have sort of got the men to sort of appreciate the women's side. And a lot of men have participated in that sessions, you know, on sort of, you know, be sort of understanding the other side. So these are few things that we've done, and it's a very, very women-friendly organization. I think I've been fortunate to have led it.
Oh, very good. I'm sure you contributed your bit to it. And you can say it several times, many times, that behind successful women, there are several men. I can tell you with personal examples. Otherwise, it's very difficult to even make a career, forget a successful career. But, you know, I've got 4 top bankers. I'm not going to discuss only gender issues. I have to discuss, and finance issues are all over the place. So, first, Zareen, Reserve Bank has announced another bunch of liquidity steps. How do you see the you know, impact going forward when advance taxes are paid? And is it enough now, the liquidity provided?
Yeah. So headline deficit has been in deficit. Headline liquidity has been in deficit for a while. It's hovered between 50,000 crores to 2 lakh crores. RBI had made a few you know, interventions. But, you know, in the process of smoothing the rupee, I think we've had rupee liquidity sort of in deficit. The recent RBI announcement on 10 billion rupee dollar swap and 1 lakh crore OMO, I think that will really help. We also find that March typically is a very tight month because of advance tax. The expectation is 1,50,000 crores of advance tax will sort of go. And but having said that, I think in May, RBI will declare 2,50,000 crores our expectation of dividend to government, and government hopefully will start spending. So in a few months...
The point is, if there is going to be this 2.5 lakh crore also coming, you can expect deposit rate cuts, because banks found the lending rate going down, not deposit. Do you expect that to happen soon?
Yes, I think so.
April?
So, our house view is that there'll be one more cut in April, credit policy. That's our house view.
Deposit cut?
So yes, deposit cuts will happen. See, it's a function of liquidity right now, right? The deposit rates are high because liquidity is tight. When liquidity eases, we will see that also playing out.
Okay, but now I'm going to get to the international bit as well. This 10 billion swap. But before I come to the 10 billion swap to Ankur and capital flows, Parul, has the Trump trade played out? Now dollar index, back to November levels. Is it a temporary reprieve?
So yeah, you're right, Lata. I think, I believe in the classic adage of buy the rumor, sell the fact. So the peak of dollar index may have already been reached just ahead of Trump inauguration, towards the third week of...
110.
Yes, 110. And from there, we've seen, a lot of events play out in the international markets. One, the Trump style of tariff. He's more of a deal maker than just going all out on tariffs across the board, across multiple countries. So that has really shaken up the confidence of the market on a one-sided dollar strength. So we've seen how dollar CNH is reacting. It's already seen the peak. All currencies, we are seeing that trend. Dollar index has corrected.
Rupee went to 87.90.
Yes, it almost touched 88. So we think the large part of dollar strength is behind us. Now, from here, we're also seeing, events in Europe where Germany is giving, fiscal support to their economy. So we are seeing signs of Chinese economy stabilizing, European economy stabilizing, and that is another countervailing factor playing
dollar
out
strength.
for, dollar strength.
Fair
so
point.
I think
that all that
continues.
makes the growth picture also different if the global growth is going to be, better than we thought. But before I come to that, this 10 billion swap has clearly pulled down the forward interest rates. My forward rates have fallen. How does that, impact corporates? Are you going to see more capital flows?
Absolutely, Lata. In fact, that was the only missing in the puzzle when it came to India macro. European interest rates were coming down and you had enough liquidity. Slowly, RBI was building in. But what was missing in the puzzle was international capital flows. On one hand, we had equity markets seeing outflows. But now this measure, in my view, will be a game changer. It will attract a lot more debt capital inflows into India, both through all the three means. The ECB loan route, the international bond route, as well as the FPI debt route. Okay. And, there is enough and more demand for India credit when it comes to international investors and banks. So I'm glad this measure has happened, especially as an international bank with a solid global capital market and a local balance sheet. We like to provide both sorts of solutions to our clients.
Debt capital flows. Therefore, this capital flow deficit, our current account deficit is just, 1 to 1.2%. But the capital flow deficit is likely to be bridged by this.
Will it get fully bridged? Maybe not. But will it reduce the deficit? Absolutely, yes. Sure. And as funding gets cheaper for the corporate, your return on equity also improves, right? So that should bring in more equity capital as well. So it becomes a virtuous cycle.
Hopefully, that we are going to see equity flows also come in. I'll ask you about that. But Anubhuti, what's your forecast of Q4 growth and FY26 growth? With the events of the last 1 week, we have to talk in weeks, are the headwinds lower or as bad?
So on growth forecast, we are expecting 6.4 for the last quarter of this financial year. And for FY25, we are at 6.5%. On your question on whether all headwinds have been addressed, I think it's still too early. With Trump around, we need to remain cautious. And while there is a lot of clarity when it comes to how, or probably there is a little bit of a clarity on how EU growth might pan out, how China is doing, clarity on India tariff is still not there. We'll have to wait for the...
April 2nd.
April 1st. Let's, that's the day when it gets released in US. So we'll have to wait for that. And our estimates show that if there is a blanket tariff increase of 10% on all goods, right? If that's the kind of an increase, then GDP can get hit adversely by 25 to 30 basis points. It's not only about tariff, right? Trump is also talking about GST been imputed. Right. And if that's also taken into account, there is some kind of tax on services, etc., then we can see it going all the way to 60 basis points. Okay. Reality will be lower in our view because there is a deal which probably will get
So
struck.
You're going with 6.5 for next year?
6.5. There is a little bit of a downside risk, but too early to quantify it, especially given that every day is a new day.
No, I must tie all down to numbers. Ankur says that capital flows deficit will reduce. You're going with a 6.5 for next year. What's the Q4 number?
6.4.
Okay, even for, no, Q4, not full year.
Q4.
Both are Q, okay, 6.4. Rupee?
Rupee, I think we've seen the worst for dollar rupee as well, in line with our expectations that the dollar strength might have abated. So what we are seeing, however, is that the rupee will continue to underperform rest of the Asian counterparts. It's a mix of things,
So
right?
88,
88
by when?
88 by when? I think we should see it. We've seen the cap. I think in 3 months we might see 88 again, but in the short term, I don't see it testing 88 again.
Okay.
But we will see RBI recouping dollars. So we expect dollar rupee to be a range trade. And around 88 levels, we do see exporters coming in and make use of that level to lock in their level.
I just wanted to supplement on the Trump bit. Yes. I think we'll see a second-order impact also, because the rest of the world also will see the impact. And India's dependence on the rest of the world for trade also, that will play out also. And the second is, one way to look at it is that on a relative basis, if every other country is also facing tariff issues, on a relative basis, we may not be so worse off.
Yeah, we may be competitive for all you know.
Yeah, we may be competitive. And the other good thing is that 60% of our exports to US is services. Okay. So, that also right now what is being talked about is goods. So I think one should take all these
buffers.
One should take all these things also into account.
Fair point.
Yeah.
Zareen, you are in the midst of a lot of corporate conversations. Are you seeing the capex cycle start? I mean, not start, but pick up.
So, Lata, I'm seeing the top business houses. If you take the top 5 or 7 business houses, the capex is happening. It's not. I've not seen them sort of, not do the capex that they've announced or sort of progressed on. So if you take the big business houses, Tata's, Reliance, Birla's, JSW, all of them are doing capex and in a meaningful way. I think what's happening is that the private sector capex is not showing in bank credit because private sector has a lot of cash flows, free cash. And any project execution, the first year they'll use their free cash more than anything else before they come to the bank market for borrowing. So
the capex cycle has started, according to you?
It is modest, but it is not stopped, if I was to use the word. It's not like we are seeing people do like 1 or 2 years of free cash equivalent capex in the private sector, but it's not what we've seen at the very peak